Greetings. So you were gracious enough to give me a couple minutes at the end of class today, so I'll give you back a little feedback on what we ended with so that it's clear, because this is a really important, up-to-date, current, state-of-the-art estate planning. What it involves is that we want to give away property. We want that property to be appreciating, and we want to try to give it away at a low value so that we can use up less of our lifetime freebie of gifts that we can give. So here's the deal. The deal is, if you can give, let's just talk about an individual, not even married, if you can give away $5.5 million before you incur gift tax, and this is above the annual exclusion that we spoke about today, then if we can give away an appreciating asset, an asset that will go up in value over time, what we're doing is we're giving away the future appreciation. We're doing it now. So let's see what that means. For example, suppose I have an asset that's worth $10 million today. In the future, let's say 2025, it'll be worth $15 million. So if I wait till 2025 to give it away by either making a gift or dying at that time, and it goes through my will, of this amount, the 11 million freebie that we can give will not be subject to tax, but 4 million will. To which we say, ugh. So what do? Well, it's very simple. Take this today and give it away now. Now, if we have 11 million free, we've used up 10, we still have 1 million left. And the future appreciation, which is the appreciation of the $5 million, that $5 million is not going to be subject to the estate tax. And that's what's cool. That is what's very cool about this. So it's the 5 million growth that will be subject to estate taxation in the next generation, but not here. All right, so that's one principle. Give away appreciating assets now. The second principle is using the same numbers, same example, 10 million going to be worth 15 million in the future. Using that same example, if the 10 million that we have today is inside of a limited liability company, so what we're giving away is not just we're not giving the property away, we're giving away the interest in the LLC. It's like giving away shares of stock. That's exactly what we're doing, the equivalent of giving away shares of stock. And so what we're going to be doing is we're going to be giving those shares of stock away. And when we do so, we're going to value the shares of stock. In this case, it's membership interest, so I won't use the word shares of stock anymore. I'll say we're going to give the membership interest away. That's the name of it. So the first thing we talked about is maybe I make the amount of the membership interest so small that it is only worth $14K. So of a large LLC with a big value, maybe it's 0.01%, and I give a bunch of those away, they'll come under the annual exclusion. So they won't even count. But then I can go one step further, and I can take the LLC and its interest, its membership interest, and I can say, well, I'm going to give away 49%. And that value might really be worth, based on the assets inside, let's say the assets inside are 10 million. We know they're really worth 10 million. But 49% of 10 million is 4.9 million. Okay, we know that too. But now we add on top of the planning and the gimmick, which is legal, and that is we say that, well, wait a minute. It's not really worth that because, first of all, you're only giving away 49%, so there's no control. So we have a discount for lack of control because it's not worth as much as it would be worth if it's 51%. So there's a discount. And then we have a discount for we can't sell it. There's no market. Unlike shares of stock, we can sell it the next day. Here we can't. So it's not worth as much. It's not worth the 4.9 million. This is standard business evaluation and valuation techniques. And if these discounts together come up to 0.9 million, then we wind up having a situation where, okay, we're giving away 4 million, a value of 4 million after discounts. Keep the 4 million in mind. Keep the 4.9 million in mind. So we're giving away really 4.9, but it's only going to be valued at 4.0. So of our 11 million freebie, our lifetime freebie, we're only going to use up that amount. We're going to be left with 7 instead of using up 4.9 and being left with just 6.1. That's the beneficial using of discounts, is that we wind up saving a whole lot right at the day we make the gift. So the lawyer, the tax accountant, yours truly can say to the client, wow, look at what we did. We gave away 0.9 million, but because of discounts, we're not getting, it's not going against our lifetime giving. So in essence, we saved 40% of this just by the very nature of the gift. We saved almost $400,000 in potential estate taxes just by the fact that we have these discounts. These are real, these are allowed, and as I said at the end of the class, the very, very tail end, currently it is controversial, legal but controversial, and the IRS is doing everything they can to tighten up the discounts, to lower them. Sometimes these discounts go up to 40% or more. I've seen some law firms go even higher than 40%. And so we'll see how this goes. This will be playing out very shortly. You'll probably hear it in the news as we get close to the end of the year and into January. All right, hope you enjoyed it. See you Monday.